All right, hello everybody. Wanted to get a video out here this afternoon highlighting our new trade from earlier in the afternoon. Walk you through why we ended up taking the trade, what are we looking for out of this position here over the next few weeks, and then also cover some things that you can do to increase your odds of getting filled on a trade. I know there's been some tricky markets here this week, tricky in trying to get filled on trades. So I'll walk you through some things that you can do there. So just briefly, some comments on the overall market. We've been talking about how wild and crazy things have been. Today is a good start for a reversal. I mean, it's crazy to look at 1,000-point rally on the Dow, almost a 450-point rally on the NASDAQ, 150-point rally on the S&P, and only call that a decent day. But when you compare it to what we've seen on the downside, this recovery today, it's a drop in the bucket. It's a start, certainly, but we need more. And what have we been talking about lately? What we want to see, if this is really going to have legs on the upside, we want to see some sessions close near the highs of the day. We weren't quite able to get to the highs at the close, but we did close near the upper end of the range. It's a constructive start. We need to see some follow through into day 2, 3, and 4. So we'll see what tomorrow and the rest of the week brings, but it certainly is a good start here. I would love to see a nice rally. Not saying the bottom is in, but I want to see a rally before another leg to the downside. I mean, for the sake of our economy, I would love to see a massive rally, but that might be wishful thinking at this point. The volume was, again, pretty large, well over 200 million shares. Definitely makes for a tricky market when the range gets this large. The market makers are going to price in the uncertainty, right? They're going to start to widen out the markets. That's exactly what has happened. As the markets get wide, when I say wide markets, I'm talking about the difference between the bid and ask prices. And as those markets widen out, it becomes more difficult to get filled on trades. And we'll circle back to that in just a second here and talk through how to handle that. The internals, pretty decent. I mean, nothing overwhelmingly positive, but it's good to see some positive readings again for the first time in a few weeks. Volume ratios 2-to-1 positive, so twice the amount of volume on the upside versus downside. That's certainly a change from the last few days. The advanced decline line on the NASDAQ up over plus 1,100. On the NYSE, it was right around plus 800. So we've got some positive readings there. We have more names moving higher than lower, but we have some pockets of weakness here still. We've got the airlines lower. You've got some of the banks lower. And remember what I've said here recently. If we're going to get a reversal, it's got to be every stock, every sector. And we don't have that as of yet. So while today was a good start, we've got a lot of work to go here in the days to come. We'll see what happens here going into the next few days. As far as our new trade from today goes, it was on GLD. This is the gold ETF that we like to track. And much like the rest of the markets, we have had a nice move to the downside, enough to give us a slew of yellow bars on the pulse indicator, representing an oversold condition. We're between a 1 and a 2 standard deviation move on the downside. Doesn't mean gold has to reverse higher from here. It just means the odds of another move to the downside are pretty slim. All right, so odds favor either a period of consolidation or even a reversal to the upside. Now, why wouldn't I come in and buy a long call? Because if you buy a long call here, a couple of issues with that. If you buy a long call, the move to the upside has to happen quickly, and it's got to be a big enough move to offset both time decay and volatility contracting. The volatility market-wide is extreme. The VIX, even though it was down $6 or $7 today, the VIX is still above 75. It's at an extreme level. What that means is options are very, very expensive here. If you're going to buy a call option, not only are you going to pay up for that, it's going to be expensive, but you need a lot to go right in your favor in order to make money. One way of flipping the cards around in your favor, you can be bullish. I have no problem with that, but I would rather be bullish by selling a put spread. Now it lowers the cost on the trade, it lowers the risk, and it gives me a higher probability of success. It's going to give me 5 ways of making money instead of one way, which was what you would have if you buy a long call. So the basis for the trade, I need at least 3 out of the past 5 bars plotting yellow. We have that. We have 5 out of the last 6 bars plotting yellow. I would love to see a move above the 8 EMA. The 8-period exponential moving average is this red moving average. We didn't quite get above that here today. I don't have to have it. but it's nice to see. So over the next day or so, that would provide some additional confirmation if we can get a candle to move back up above the 8 EMA. Going over to the trade page, you can see the IV percentile is pinned at 100. Remember, the implied volatility is the number that is being used to price the options. Anything above the 50th percentile is considered high volatility. Well, we're at 52-week highs. We're very elevated here. Chances are over the next few weeks that volatility is going to want to contract. It's going to want to gravitate back down towards the 50th percentile. And as volatility decreases, it's going to cause the options to lose value. We're trying to take advantage of that fact by selling a credit spread. Now, from the alert earlier today, we decided to use the April 17 monthly options with 31 days left to expiration. And by the way, I'm going to show you here in Thinkorswim. I'll also show you in Tastyworks as well. I'll switch on over to Tastyworks in just a second. From the alert, I mentioned we wanted to sell to open the 17 April 20. So the 17 April 20 monthly options right here. We wanted to sell the 139, 137 put spread. In other words, we're selling the 139 put and we're buying the 137 put at the same time. And we're looking to get filled at 50 cents or higher. So I'm going to go over to the puts on the right-hand side. We're going to right-click on the 139 puts. I'm going to go to sell, and I'm going to go to vertical. That's going to pop up an order down at the bottom where I am selling the 139 put. And then from the alert, I wanted to buy the 137 put. So I'm going to click on that drop-down menu and switch it to 137. Now, I wanted to collect 50 cents or higher. It's now trading for 65 cents mid-price. Right? So that's great. Anything above 50 cents is acceptable. Now, let's say that you place your order at 65 cents and you don't get filled. This has been an issue over the past week or so because the markets have been so wide. And when I say wide markets, what I'm talking about is the difference between the bid and ask prices. If I go to the 139 put, see how there's a 20-cent difference between the bid and ask prices? In a lot of cases, historically, GLD has markets that are very tight, where the difference between the bid and ask is usually a few pennies wide. It's a wider market here because they're trying to price in the uncertainty. All right. As a result, you're not guaranteed to get filled at your price. If you place the order at 65 cents and can't get filled there, what can you do to increase your odds of getting filled? Well, because this is a sell order, an adjustment that you can make is to adjust the price lower, to go from 65 cents down to 63 cents. As you move that price lower, it's going to increase your odds of getting filled. The trade-off there is as you move that price lower, you give up profit potential. Okay, so there's the trade-off. Now, on the flip side, if you create a buy order, let's say you're trying to buy an option instead and you can't get filled, if you adjust the price higher, you will increase your odds of getting filled. But as you do so, you're just paying up, right? You're going to tie up more capital to put that position on. So I always start my orders at the mid-price between the bid and ask, and then I adjust from there, following what we just talked about. If it's a sell order, I can't get filled, adjust the price lower. If it's a buy order, adjust the price higher. When I say adjust, only adjust 1 cent at a time. Move the price 1 to 3 pennies in most cases. If it's a higher price stock like Amazon or Tesla, yeah, you can adjust in larger increments. But in most cases, make small adjustments. If you're not filled at 65, move it down to 64. If you're not filled at 64, move it to 63. I don't want to get ultra aggressive and go from 65 to 60 because that's just giving up some profit potential. I want to be cautious there. So I will adjust very slowly. And in most cases, as you adjust a penny or two, you're going to get filled. All right. So if we're filled at 65 cents, and actually let me grab, that's exactly where we were filled. I wanted to check the fill price on my side. So 65 cents, we are risking 135 to make 65. So right around risk 2 to make 1. Very normal range for us. Because it's a credit spread, I am willing to risk 2 to make 1 because we've got 5 ways of making money on the position. Our break-even point's at 138.35. That number is calculated by taking the short strike, the 139 put that I'm selling. We're subtracting the 65-cent credit, and that gives me the break-even at 138.35. I don't care if GLD moves up, down, or sideways. As long as it stays above 138.35, I can make money. I also make money from time decay adding up and from volatility decreasing. So now I've got 5 different avenues to go here, to follow, to make money. I'm not solely dependent on GLD moving to the upside. If it does, great. It's going to allow me to make money faster. I just don't need it. I can make money other ways on this position. Because I'm collecting 65 cents, my target zone is when I can close out of the position and keep between 50 and 75% of my max profit. So because I collected 65 cents, that's my max profit. If I can buy this thing back between 16 and 32 cents or so, that would give me 50 to 75% of our max profit. So I would set my closing order for 16 cents and just let it work there. Okay, just let it work over the next few weeks. If we get down and touch that level, great. But then also, if you don't get that closing order working right away, not a problem. We'll always circle back and let you know when we're closing out of the position on our side. All right. Let me show it to you really quick in Tastyworks. Let me pull up the Tastyworks platform. When you log into Tastyworks, there's a symbol box up at the top. I'm going to switch this from Costco to GLD. Down the left-hand side of your platform, you're going to see a vertical toolbar. We're going to click on the trade button here. And that's going to bring you to this page where it shows you all of your expiration cycles down the left. It shows you the number of days left to expiration down the middle column. So what I want to do from the alert, we want to trade the April 17 option. So I'm going to come down and click on the arrow next to the April 17 options. It's now going to show you all of the strike prices that you have available to you. In the upper right-hand corner, there's a drop-down menu that says strikes. You can always select more or less strikes here. So if you need to load up more strikes, you certainly can. Just click on the drop-down menu and put in a bigger number. From the alert, we mentioned we wanted to sell the 139, 137 put spread. So I'm going to go to the 139 puts. I'm going to left-click on the bid price of that 139 put. And as I do so, it's going to box it in red, indicating a sell order. I'm then going to go to the 137 put and left click on the ask price. And as I do so, it's going to box it in green. I'm going to do both orders. So I'm going to do both options at the same time. It brings up an order down at the bottom. And let me get rid of that message there on the screen. So it's going to pop up an order down at the bottom where I am selling one 139 put. STO stands for sell to open. And I am buying one 137 put. BTO stands for buy to open. The price in the middle, you can change the price to anything you want. You can either arrow up or down, or you can just come in and type in whatever number you want to place for the order. All right. The quantity here, left and right arrows, if I wanted to trade 3 spreads instead of 1, just go ahead and left click on the arrow. And now you can see I went from -1 and +1 to -3 and +3. So I'm just changing the quantity there. The order type needs to be set to net credit anytime that you are selling a position. So in this case, we're selling to open. You want that set to net credit. Time in force, TIF, it's set to a day order. Anytime that you're placing an entry order, you want to use a day order. You can use GTC, that stands for good till cancel, but I would only do that on a target or a stop order, and only on an exit order. So set it to day order, click on review and send the order, and you're good to go. All right. So we'll continue to manage this new GLD position here over the next few weeks. If you have any questions on this position, certainly let me know. You can send me an email, mike@netpicks.com, post a question inside of Slack, or post a comment in the NetPicks app, and I'll be back with you right away. So very busy week so far. I expect that to continue here over the next few days. We'll see what happens, see if we can get some new positions on as well. So enjoy your evening, everybody. I'll be back with you over the next few days with our next setup.